Good morning from Liechtenstein, ladies and gentlemen. My name is Ronald-Peter and I'm a fund manager at Incrementum. I'm also the author of the annual In Gold We Trust report that we just published a couple of days ago. As you know, it's quite a brick. It's 350 pages, so it's lots of reading for your holidays. And in the next 20 minutes, I will present the highlights of our 2020 In Gold We Trust report called The Dawning of a Golden Decade. It wouldn't be possible to put out such a massive report in English, in German, and in Mandarin in an extended and in a compact version. To put it out for free without the support of our fantastic team. We've got great premium partners that support us, but we also have more than 20 people now working on this report, crunching the numbers, preparing all the material, the charts, proofreading, editing, translating. So thank you very much to our premium partners and to the whole team that made it possible to publish such a big In Gold We Trust report again. Now let's jump into the discussion. Paul Tudor Jones recently said, "We've counteracted this existential shock with the greatest fiscal and monetary bazooka. It's not even a bazooka, it's more like a nuclear bomb." Ladies and gentlemen, if you remember our 2019 In Gold We Trust report, we said that an erosion of trust is actually happening. And back then we said that the biggest bubble out there is the trust in central banks. And basically the people being very, very sure that central banks will bail us out of everything. And from my point of view, this trust in central banks might start eroding going forward. Now let's have a look at this chart. It shows you the balance sheet expansion by the ECB, by the Bank of Japan and the Federal Reserve. And what you can see here is that the measures that were taken were much more aggressive than in 2008. We should not forget, the longer this deflationary pressure continues to be in markets, like we're seeing it now, the more relaxed central bankers will feel to continue this expansion of their balance sheets. And from my point of view, it is something that central bankers completely underestimate, is this time lag between the injection of their measures and the effect of their measures, of their balance sheet expansion. But this time around, it is not only unprecedented monetary stimulus, it is also unprecedented fiscal stimulus. Now you can see all the measures that were taken from the ECB and the Federal Reserve, like PEP, CPFF, PM, CCF, etc. A friend of mine once said, the more acronyms used, the worse the crisis, and I think it's quite fitting this time around. And if we try to put those numbers into perspective, they are really unbelievable. So just in the very first week of the COVID crisis, the Federal Reserve printed $550 billion US. Just to put it into comparison, that's 5 times annual gold production. We've hit $1 trillion of balance sheet expansion just in 2 weeks. So basically, it took the Federal Reserve 8 months to do. It took the Federal Reserve 2 weeks to do what they did in 8 months in 2009. So far, if we have a look at the total monetary and fiscal stimulus, it is $22 trillion US, which is twice the market cap of all the gold that was ever produced. And it is roughly 10% of world GDP. But as I've said, this time around, it is not only unprecedented monetary stimulus, it is also unprecedented fiscal stimulus. And I think this combination of monetary and fiscal stimulus will be one of the main differences regarding the outcomes compared to 2008, 2009. We can see that the measures that were taken were basically showing that inflation expectations rebounded much, much quicker than in 2008 and 2009. Now, of course, as I'm an astute follower of the Austrian School of Economics, I'm a bit critical when it comes to such highly aggressive measures. And Stephen Poloz, the former governor of the Bank of Canada, he put it perfectly. He said, a firefighter has never been criticized for using too much water. So in doubt, ladies and gentlemen, central bankers will be extremely aggressive for a long time to come. And I think our biggest worry should not be that central banks will print too little, but probably too much going forward. And the price of gold is already discounting that. As you know, I've written more than 3,000 pages of research about gold, and it still fascinates me because gold is discounting so much information. Gold is traded 24/7 all over the globe. It is something special in basically every society, every culture, every religion. And therefore, I think that the price of gold was already discounting something last year. I think it's a bit unfair to say that gold now only reacted to the COVID crisis. If we have a look at this slide, you can see that gold already did very, very well in 2019. It was up 19% in dollar terms, 22.7% in euro terms. And now, of course, gold showed a fantastic first half of the year with 17% roughly in US dollar in euro terms. So gold is rising in every currency. And this is a very, very strong sign that this bull market has really got legs. But it is not, from my point of view, it is not the price of gold rising. It is rather the purchasing power of fiat currencies depreciating. No fiat currency has survived the test of time over long periods. And what you can see here is since 1971, basically all currencies, the Swiss franc, the euro, the US dollar, and the British pound, massively lost purchasing power versus gold. I think it's no coincidence that the Swiss franc did in comparison quite well. I think one of the main reasons is that the Swiss franc was, until a couple of years ago, still backed by gold. And if you have a look at this chart, you can see that in the 1970s, there was an enormous devaluation of fiat versus gold. Then the 80s and 90s were pretty much okay because real interest rates were positive. And then starting in 2000, another downtrend set in. And I think a similar development like in the 1970s, a stagflationary development is in the cards. Now, gold did exactly what it's supposed to do. I once said gold is the Franz Beckenbauer of your portfolio. It is a very defensive and reliable, stabilizing player in your team. And you can see gold in local currency versus domestic stock indices. Gold did extremely well to stabilize your portfolio. So gold was up in all those currencies. And of course, those numbers for the stock markets in April and in March, they were even more negative. Now, equity markets recovered lately, as we know, but still, gold did its job brilliantly. It stabilized your portfolio. It basically insured your losses on the equity side. And gold is now outperforming the stock market, as you can see here on this ratio. And it is not only that gold is outperforming the stock market, we can also see strength versus the bond market. We can also see that mining stocks are outperforming gold itself. We can see that junior stocks are outperforming the senior stocks. And those are all signs for me that the strength of this bull market is really, really superb. So I think this bull market clearly has legs. If you have a look at ETF demand, it is obvious portfolio managers are rediscovering gold again. We are seeing new all-time highs in ETFs, which is a clear sign that money managers, wealth managers, pension fund managers are piling into gold again. And I think one of the most important drivers going forward, ladies and gentlemen, will be inflation, or rather stagflation, the ultimate pain trade. If we have a look at this chart, it is obvious that within our monetary system, deflation cannot be accepted. It cannot be tolerated. While when we were on a gold-silver standard, basically from 1785 until 1913, more or less, deflation was just something normal. But in our highly indebted fiat money system, deflation cannot be accepted. And this is the reason for me to believe that as soon as deflationary pressures come back, I think central banks will act again extremely aggressive, because deflation is the biggest scare that we are having. And of course, the higher the debt level, the bigger the scare, the bigger the fear of deflation, and the higher the desire for inflation. What we can see here is the federal debt since the year 1790. We're making new records. According to the Congressional Budget Office, the federal budget deficit in the US will hit a new peacetime record of 18% in 2020 and 10% in 2021. The tally of new debt globally could exceed 20 trillion this year. And I think under a president that calls himself the king of debt, and of course in an election year, expect much more to come. So from this point of view, I think it is obvious that from a systemic point of view, inflation definitely will be the name of the game. And Mario Draghi just said it in a editorial piece in the Financial Times. Much higher public debt levels will become a permanent feature of our economies and will be accompanied by private debt cancellations. Very interesting from my point of view. Now, rising inflation is definitely a contrarian call still. As you can see here, The Economist, but also Bloomberg Business Week, don't see any inflation reappearing. From talking to institutional clients of us, I can tell that they are becoming more and more concerned regarding inflation. Still, we're at the appetizer. So I think inflation or stagflation will be the main course or the dessert, but investors should prepare accordingly. And our incrementum inflation signal is showing a full-blown rising inflation signal at the moment. So markets are discounting rising inflation at the moment. Now, we can see that gold rises in attractiveness due to negative yields on bonds. At the moment, there are 12 trillion, so 12,000 billion on bonds trading at negative yields. Of course, if inflation should become a concern, money will flow out of those bonds. It will flow into the stock market, of course. It will flow into real estate. But I think that gold, being the most reliable inflation hedge over the last centuries, will be one of the main beneficiaries of those capital flows. Let's have a look at the mining space. In a bull market, the sidelines is the worst place to be. Definitely. If we have a look at the HUY index, the gold bucks index, you can see that the last couple of weeks were, of course, big fun for investors. We also saw massive volatility in the gold mining space in April. But if you have a look at this chart, you can see that actually the mining stocks are still trading at a very, very cheap level. They're basically trading at the same level like when gold was trading at 1350 in the middle of 2016. So I think there is still lots of bargains to be found in the mining space. Now, gold mining stocks are also quite cheap compared to gold itself. have a look at this ratio of the BGMI, the Barron's Gold Mining Index, versus gold itself. You can see that we are far away from the mean. We are very close to the all-time lows in this ratio. So mining stocks relative to gold are still dirt cheap at the moment. And you can see on this chart where we are showing all bull markets in mining stocks since the year 1942. You can see that basically this party has only started. We don't see any irrational exuberance. We don't see any big parabolic move yet, like we're seeing it at the end of every big trend. Therefore, I think that, of course, we can take a breather anytime, but still, it is only the starting phase of this bull market. Now, I'm already coming to a conclusion. Of course, I could talk for many more hours because, as I've said, the report has got 350 pages. But I think we will see a golden decade ahead. Bull markets are more fun than bear markets. That's what Bob Farrell said. And on this chart, you can see that gold entered the so-called public participation phase last year. And from my point of view, we're only at the beginning, probably in the first third of this public participation phase. This is the phase where the media picks up on gold again. This is the phase where analysts raise their price targets. This is the moment when generalists coming into the market. But we are far away from this last phase, the so-called distribution phase. Let's have a look at generalists and institutional investors. They haven't really joined the party yet. What you can see here is ETF holdings as a percentage of total US market cap. We're still quite away from the highs that we saw in 2011, 2012. From my point of view, institutional investors will rediscover gold. And I think primarily the mining space, but also ETFs will profit from that. Let's have a look at silver. Silver is historically extremely cheap relative to gold. So in this year's report, for the very first time, we had a special chapter on silver where we explain the supply-demand picture of the silver space, and we come to a very, very positive outlook. Just based on the relative valuation, silver is extremely cheap, not only relative to gold, but relative to most other asset classes as well. And commodities itself, they're trading basically at the lowest valuation relative to the S&P 500 since the year 1971. Now you can see that these bottoms were also the tops in the US dollar. So if you expect a weaker US dollar, you should have at least some commodity exposure. And now with all those massive fiscal programs, with all those monetary programs that were installed and that will be implemented going forward, I'm having a hard time not being bullish on the commodity space. In our gold price model, it comes to the conclusion that we will see a gold price at 4,800 US dollars by the end of this decade. Now that might sound like a lot, but it is rather conservative. And if you calculate the numbers, 4,800 US dollars at the end of this decade is a CAGR, so a compound annual growth rate of 10.4% until the end of the decade. So doesn't sound too far-fetched. And it's interesting that our distribution is at the end very much skewed to the right. So the probability of higher gold prices than those $4,800 is much higher than the probability of lower gold prices. And that already brings me to my core views, ladies and gentlemen. Welcome to the mother of all stimulus. We are already seeing unprecedented monetary and fiscal stimulus. After the corona crisis comes the debt crisis. Rising price inflation continues to be priced by the market as a tail risk. Silver will outperform gold in the course of the bull market. Mining stocks and commodities will be a major beneficiary of monetary and fiscal policies, and gold is back in a bull market. We will see many new all-time highs in basically every currency. Ladies and gentlemen, I hope you enjoyed this very brief overview. And as Kirill Sokolov said, all roads lead to gold. Thank you very much, ladies and gentlemen. Thank you.